what's going on, guys? Uncle Swan, Steven is in here. So we are going to just be hanging out. I have a few things to listen to with you guys. If you have anything you want me to react to or talk about, put it in the chat. I'll be watching that as well. Yeah, I think I'm just going to record it here. Maybe I'll put it up later onto YouTube. I don't know, the lives don't really perform that well, so on YouTube at least, and so I think I'm going to be doing just putting up videos. Those seem to do better. I've also been putting up shorts and things over there on the Rogue Macro channel, so make sure you guys check that out. Subscribe over there on YouTube. It's just Rogue Macro. And I've done a couple quick streams on that on the X handle over there, so check that out as well. Make sure you guys are subscribed. Falcon, what's going on? Okay, so what did I want to get into here? We're going to take a look at the charts real quick. Nothing too exciting. Actually, I think the website is down right now. Let's see. Okay, now it's back up. Never mind. It is back up now. All right, so we're going to take a look at the charts and the price for today. Let me see. Oh, man, I just deleted that whole indicator. Damn. And then I have a few little short videos to watch and then react to whatever you guys have as well. So let's go ahead and get into that. Bag, what's going on? Okay, so here we have the price. You guys are familiar. I did put out a post here. It's an FOMC preview. Then I take a look at a few things around the AI space. I take a look at NVIDIA, Equinix, I think it's called. It's a data center. It's like one of the largest data center providers. And also the ticker AIQ, which is the AI ETF. And it's not just AI companies, it's companies that use AI or that are going to be greatly affected by AI. And so I take a look at those things for the AI bubble. And of course, take a look at gold and Bitcoin and give an update on that. So that's the post that I just sent out. But okay, so let's see. We have here Bitcoin still holding on. Let's see, this is the weekly. So let's bring up the 50-week moving average. And as you can see, we've held that very nicely the whole way. It looks like we are getting ready for another bounce. And if we take a look at the CME futures, same thing. So 50-week moving average has really been supportive for the price. It gets a little bit hairy when we get down onto the 50-day because they are different days, you know, with CMEs and traditional. Even though right now it's very flat, both are in the relative same position, but that is because we have been flat. And so that same position is just kind of the mean price for the last little while. And both of these are showing it right there in the middle. But man, look at this nasty daily candle here. Looked good yesterday and today, going all the way up to about 116 today, and all the way back down now into the 113. So this is really struggling to break out here for Bitcoin, but I'm fairly certain that we are about to have a breakout. Here is gold. Of course, I've been talking about this a lot. Have completely broken this most nearest support, and so we're going to see if it can find some other support. Of course, this is the 50-day moving average right here. That might add some support, but I really don't think so. I think this is bound to really pull back all the way down here to 3,500. I really do. So that's that. I haven't looked at any of these other ones today. No big movers. Maybe oil here bouncing down off of the 50-day moving average, and the SP 500 just gapping up to a new all-time high again today. It's just nothing stops this train for the stock market. All right. So that's that. Let's get into, let's make sure this is sharing properly. Okay, so these are some of my likes. And we're going to go through a few of these videos. This was very classy. One of the bigger news items today was Takaichi, the new prime minister of Japan, visiting, or no, the U.S. was visiting there, right? Trump was visiting there. anyway, this was a very awesome gift. So Japan is donating 250 of the famous cherry blossom trees to Washington, D.C. for the beautification project. I think it's like, this is very classy diplomacy. It hits Trump in the right way. And it's just like high IQ type of diplomacy, in my opinion. Lots of stuff going back and forth about this meeting here today. It really does look like the U.S. and Japan are going to be pretty tight going forward. And that's one of the things I've talked about over the years, is the U.S. is going to have just a few really tight partners. It looks like Japan is shaping up to be one of those very tight partners. I thought maybe the UK could be in there, but perhaps it'll be Argentina as a third. So if you have Japan, the US, and Argentina, you really have a very good core alliance that can be its own like regional multipolar hegemon, right? And I think it could work very well. And we're seeing that with the Japanese stuff today. Here's more.
This woman is a winner. So, we've become very close friends all of a sudden, because their stock market today and our stock market today hit an all-time high. That means we're doing something right. But the cherished alliance between the United States and Japan is one of the most remarkable relationships in the entire world. Really, there's never been anything like it. Born out of the ashes.
All right. Yeah. Okay, what else do we got? Let's find some of these videos. Oh, speaking of charts, we just went over a few charts. Let's take a look at this. I also put this into the premium post that went out today and talked about this a little bit more. So the Russell 2000, whenever it breaks out from its previous consolidation, Bitcoin broke out as well of its consolidation to the month. Now, this one was Bitcoin was a little bit delayed, but remember this all-time high from back here in 2013, it was a massive wick blow off top. And so there's a little bit of funny business going on. So you could really move this red line down slightly, and then it would line up perfectly with the Russell 2000 breakout. This one, same thing. Within a very short period of like 1 month, it broke out the Russell 2000 and Bitcoin. And now this one is slightly upward sloping on both Bitcoin and the Russell 2000, but the Russell 2000 is breaking up above that. So this is extremely bullish, and everything correlated with Bitcoin is actually starting to make its move. So this Russell gold, Bitcoin usually takes off once gold is finished with its rally. Gold is now finished with its rally. And so everything is lining up for this to be very soon for Bitcoin to make its run at a new all-time high and perhaps 150 going into the end of the year. We'll see where that takes us. There was a video. Let's see. I don't know if I want to watch that one. Let's go down to the St. Ange, however you say his name. This one. Let's listen to this one.
6 months into tariff. New numbers say inflation is cooling again 6 months into tariffs that were supposed to send us into hyperinflation. And cat food for grandma, guess it was transitory. Last week, the notorious Bureau of Labor Statistics released CPI inflation for September. Note, September means before the government shutdown, and the BLS itself is laid off as non-essential in the shutdown, but they forced them to come into the office and tally up CPI since it's used to calculate next year's Social Security, and we don't want riots at Golden Corral. Inflation for the month came in at 0.3%, down from 0.4 last month. This sparked a rally in stocks since it's a green light for the Fed to keep cutting rates, with markets expecting 2 more cuts by the end of the year, which would basically take us to neutral. This matters because lower rates spark growth. By one estimate, each point of rate cuts is worth almost 1 million jobs, but lower rates also spark future inflation.
Oh, come on now, man. This is not true. This is not true. I mean, there can be correlations, but it's not causation necessarily. So like we've talked about with the interest rate fallacy is, as interest rates go down, they go down because money is tight, right? They go down because of bad times. And then what follows bad times? Good times. So it might seem like lower rates cause growth or recovery, but that's just because that's what comes after, the decline. After decline comes recovery. And it's not necessarily due to the Fed policy or to interest rates. I mean, they're symptoms of the larger situation, right? And so I don't know.
The inflation, however, usually takes a year or two to show up, meaning the jobs are here today for the midterm election's sake, but the inflation may not appear until the next president, in case you are curious why presidents always want lower rates. The problem, of course, is 0.3% monthly inflation is still high.
That's whenever you hear lags, like that's one of my big things is lags. When people talk about lags and they can't define exactly mechanically how the lags work, they just say it tends to show up 12 to 24 months later. That's because they don't know what they're talking about. And most likely there's no such thing as a lag. Most likely it's an independent process that's going on. And just like I said, recovery follows a deterioration. Well, other things can naturally follow other things. It doesn't have to be this lag, that lags are out there in the economy, because they can't define a lag. They can't say why they work. They can't even pin down what the effects will be. And guess what? This month they'll say, oh, it's going to be a lag and we'll have to wait for 12 months. Well, what happens in 12 months? No one ever goes back and says, oh yeah, there was this lag and it took 13 months to show up. Nobody ever goes back and checks it. It's all just theoretical, right? So when you hear people talk about lags, just kind of understand that they really don't know what they're talking about. They're kind of extrapolating from their theory is what they're doing.
That's a 3.5% annualized, way above the Fed's imaginary target of 2%. The extra inflation last month was almost entirely from energy, with gasoline prices up 4% in a single month. Now, that was mostly one-offs, a perfect storm of refinery maintenance, a strong Labor Day, because when wages are strong, people drive more. Meanwhile, domestic inventories are tight between rising exports of American oil and falling production in Russia and Iraq. Everything else behaved. Food inflation was 0.2%, down from 0.5% the previous month. That's despite soaring beef prices, where Trump is now quadrupling beef imports from Argentina to take the edge off. Rent was a paltry 0.1%. Deportations have consequences. Used car inflation also plunged, which is also an indicator of deportations. They have to sell the car on the way home. Tariffs once again failed to show, to the point multiple Fed members now think tariffs may have no durable impact on inflation. Better late than never. I've been predicting for a year now that tariffs will not do much to inflation. So what's next? Brought to you by I Trust Capital.
Yeah, same thing. The tariff and inflation scare were extremely oversold. And I was saying that from the beginning. We don't know exactly what was going to happen because it's a dynamic economy, right? And like Lacey Hunt and others have said that there's this elasticity. Even the administration, when the administration first put out their tariffs, remember on Liberation Day, and they were saying, like, these are our calculations, how we get to our level of tariffs for these people. And people were poo-pooing on it. And they said, no, this is our calculation. We're doing this because from last administration, when they added the tariffs, they measured out the import elasticity, demand elasticity, and they found it was about 3. So for every 1% of tariffs, you had a roughly 3% drop in demand for imports. So this is the calculation. It's a dynamic environment, and you can't just say, my theory says tariffs are a tax. They will increase prices, yada, yada, yada. You have to deal with the dynamics of the actual environment. Now, I'm not saying that, we can't make any generalizations of supply and demand and that kind of nature, but they all are working within a more dynamic system. We don't even know the supply of money, right? We have to infer what's going on with the supply of money, what's going on with liquidity of money based off of price movements and interest rates. And so it's the same thing with these tariffs and with making hard and fast predictions about, by the book, what's going to happen with tariffs. You run the risk of not knowing a major variable that's going to also be affected by tariffs. So what drove my analysis and my thing where I'm saying that tariffs aren't going to cause very high inflation is because nothing is going to cause very high inflation. I mean, just think what happened in COVID, guys. Just think what happened in COVID. All of those stimulus checks. I don't know if you added up all the stimulus checks in the United States per person, it was around $5,000. I think I would have to go back and add them all up, but I think it was around $4,500 to $5,000 per person for a stimulus check. Plus they did all that government spending, right? The Fed did all this QE. And all of this effort, I mean, it was a monumental effort. Remember, they said half of all dollars were printed in 2020 or something like that. Monumental effort. And what happened to prices? What happened to CPI? It peaked at 9% year over year. It peaked at 1.1% month over month for 1 month, and then it crashed down to zero. So that monumental amount of spending got us to 9%. What would it take for really high sustained inflation to happen? I mean, you would have to be doubling, you'd have to be doing that COVID amount every single year. You know, increasing the credit, increasing the government debt, whatever you want to say, increasing all the stimulus, doubling it every year just to maintain that. So we can know that there's not going to be sustained inflation in the future. If you throw tariffs in there, guess what? That's just going to deteriorate the economy more, and it's going to lock in more deflation. It's going to bring about more deflation in the future. Tariffs aren't stimulus. I mean, there is some stimulus here when we have a bunch of investments into the United States. Trillions and trillions of dollars now have been pledged to invest in the United States. That's stimulatory. That can cause some price rises, okay, and some inflation through expansion of credit. But tariffs aren't stimulatory. That just should make sense. Tariffs do not stimulate the economy. They actually make it the hurdle rate higher, right? And so it's pulling down on inflation. It's disinflationary. Hope that makes sense. Okay, so that's Peter. Let's see what other. I saw some of these were really good. This one right here is from Jesse Myers, Once Upon a Species. And he has strategy up here, if you guys can see this. And it's tapping into these other markets. So Bitcoin over here in the top left, it's a $2 trillion market. You have gold, 22 trillion, art and collectibles, equities, real estate, bonds, money. And these are the different products that are sucking value into Bitcoin. So MSTR is in the equities market, and it's sucking that money into Bitcoin. Strife and Stride and Strike, those are in the bond market, and it's sucking that value out of the bond market and putting it into Bitcoin. And then Stretch is in the money market, and it's pulling that and putting it into Bitcoin. There was an update to this one by Joe Consorti, who has been on the spaces a couple times in the last couple weeks. If I can go back up here and find it. He is at least a spokesman for Horizon. I don't know if this is his project or if this is, he's just working with other people. But Horizon is tokenizing. It's doing, or not tokenizing. There's something with mortgages and Bitcoin collateral with mortgages. And so they're tapping into this real estate market and pumping it up. So everything is being tapped right now and flowing into Bitcoin, which is pretty amazing. I should have Joe on just to talk straight up about Horizon. All right. What other videos? I had another video I thought that I wanted to look at. Oh yeah, Luke Groman, guys. Good old Luke Groman. I think this is from one of his like paid letters or something, because this is Mark 4XX, and it says Luke Groman just dropped a truth bomb. Why the gold bull market is far from over. So this should be interesting. Forget charts, forget technicals. Forget everything that doesn't agree with me. Like what? You want to forget the price too? Like what's the chart made out of? It's made out of prices. Okay. Should we just forget price? Like, what are you measuring a bull market in then? I mean, oh, forget charts, forget technicals. Yeah, don't look at the most overbought gold market in 52 years. Don't look at that. Okay? Don't you dare look at that. Oh, this is going to be good. He says the entire gold bull run hinges on just two questions. Question number one, will the U.S. allow China to manufacture all its future weapons? What? I mean, I know that there's a lot of U.S. weapons manufactured overseas. Let's see. What percent of U.S. military weapons are produced in China? I know there's specific parts, like chips, they have to be made for all the different like aircraft and stuff, but all of the weapons, you think all of the weapons are going to be made in China? Kind of ridiculous to even say that. While the U.S. produces the vast majority of its finished weapons, a significant portion relies on Chinese-sourced materials and components, making it difficult to put an exact percentage on the finished products. Reports indicate that over 78% of U.S. military weapon systems depend on Chinese materials, while 41% of defense semiconductors are sourced from China. So 41% of the semiconductors, and then we have 78% of there's some Chinese materials. So, most of the advanced manufacturing. So think of the advantage that China has in bulk manufacturing. Like if you look at how much steel they create, how many raw earths they refine, that kind of stuff. That's a vast majority of the world of those bulk commodities that are created by China. But when you look at very advanced systems, advanced technology, the U.S. is the leader in that. Let me Google that. Uh-oh. Okay, let's see what the AI says. No, the U.S. is not the sole leader in advanced systems manufacturing, but it remains a major player, particularly in some high-tech sectors like aerospace, defense, core components like semiconductors. However, it has fallen behind in countries, notably China, in overall advanced manufacturing output. So again, here's output. I'm talking about quality over quantity, all right? So when you're talking weapon systems and you're talking Chinese weapon systems, they might be able to build some without the United States, just like the United States is able to build stuff without China. It's just a little bit silly to say what Luke is saying here, that 100% of U.S. weapons are going to be built by China. They're going to build our bullets. They're going to build our sidearms. Like what? It says all its future weapons. It's a little ridiculous. And question 2, will China and Russia install puppet leaders who will sell their national assets for pennies and fund U.S. deficits forever? I don't even get why that's an important question. But anyway, let's listen to Luke and see what he has to say.
Determining whether gold has topped is primarily a function of just 2 questions. Number 1, is the U.S. willing to let China make more and more of its weapons for us and eventually make all of the weapons for the U.S. military?
No. Next.
Question number 2, will China and Russia elect or otherwise institute Yeltsin-like leaders who are willing to sell off their country's assets to American interests for pennies on the dollar and then turn their nations into full-on U.S. economic vassals willing to buy infinite amounts of treasuries with surpluses at negative real rates and thereby allowing the U.S.
Oh my God. Let's rewind this, and I want you to look at all of the different conditions he puts on this one question. Oh my gosh. It's kind of silly.
And Russia elect or otherwise institute Yeltsin-like leaders who are willing to sell off their country's assets to American interests for pennies on the dollar and then turn their nations into full-on U.S. economic vassals willing to buy infinite amounts of treasuries with surpluses at negative real rates and thereby allowing the U.S. to expropriate the wealth of those countries fully in order to support Washington largesse and U.S. defense payments and U.S. entitlements payments.
Of course not. Of course not. Now what? How does this mean that the bull market in gold is not over or it's over?
If the answer to either of those questions is no, then the top in gold is not in.
Okay. I mean, maybe. But look, if I would have said, if we go to the chart, and let's make sure that this is on here. If we go to the chart, we go to gold, we go to the monthly, okay? And we zoom out. Let's just go here to this top, 2011. If I told you in August of 2011 that the gold bull market is over, would I be correct? Would I be correct? It went down 45% over the next 4 years. Of course. Of course. And are those conditions that Luke Groman was talking about, were they also present here? Of course they were. Those trade-offs, same trade-offs. What if we go back here and say, oh, in January 1980, is the bull market over for gold? I mean, no, if you zoom out enough, right? If you zoom out enough, no, it's not over. It still goes up. But it took 20 years for it to go up. So yes, the answer to Luke Groman's questions are no, but that has nothing to do with whether the gold bull market is over or not. Oh my gosh. I'm sure he's a nice guy. I'm sure Luke is a nice guy. He's a father. He's got into Bitcoin. I think he got his son into Bitcoin, or his son, he supported his son getting into Bitcoin. He seems like a very nice guy. He's not, I don't think that he has any bad faith whatsoever. But it is amazing that he is a macro analysis analyst. It just blows my mind. Okay. So that's that. Let's go back to this.
That's how I'm thinking about it with my own money.
Okay, that was it. Let's see what else we got going here. If there's any other videos we can watch. Okay, here we go. I was thinking about reaching out to Raul Paul, actually, even though I think he's a major scammer. I was thinking about reaching out to him, seeing if he'd come on a space. Oh, that'd be funny. But here we go. Let's listen to what he's talking about with cycles, because this is really interesting. So, guys, I've been around Bitcoin for a long time, and I've seen different theories, different types of cycles, explanations for the cycles. And the halving was the explanation. That was the explanation. And now we're kind of looking for another explanation. And this one, this ISM, PMI, and kind of overall liquidity is extremely interesting to me. It also works when you look at things like the copper to gold ratio, which I want to look at as well. Let's do that first, actually, since I'm thinking about it. Copper to gold. And I wasn't sharing the right screen anyway, so let's go to copper to gold. I have it. I think I have it here somewhere. Copper to gold, copper to gold, copper to gold. Where are you? Huh. I have Bitcoin to gold. Thought I had copper to gold on here. Whatever, we can look it up. Copper to gold. And let's take that 50-day moving average off. Oh, this is a month. But this doesn't go back far enough. This only goes back to 99. I guess that'll be fine for our use case. But as you can see, we're hitting very, very low levels here. That means gold is way higher relative to copper. Gold is very high relative to copper. And that's why this is very low. And typically, this goes down when? When would gold outperform copper? In the lead up to a recession. All right. So in a boom time, copper is going to outperform gold because there's less uncertainty, less risk. And so people will hold less gold and they will be using a lot of copper, right? There'll be a lot of demand for copper. So copper to gold ratio goes up in boom times and down in busts. Okay. Up in boom, down in bust. What does this tell you long term about what's happening right now in the world? Okay. I really want to get a longer one because it'll go back further. But notice the top here, 2006. Okay. Then we start going towards recession. It's going down. And we have 2008, 2009, and the bottom falls out. Okay. Then we get a recovery. But look at the general trend since that time. Since that time when we had the big bust. It's downward. The trend is downward. And that's very important. Because what does that tell you about the general economic trend over the last 20 years? The general economic trend is downward. It doesn't necessarily feel like that. We have GDP growth is supposed to be 3 to 5% and all this stuff. But look at the ratio here, the copper to gold ratio. This is showing deterioration for 20 years. And also this particular portion right here at the end is longer. So if we measure these periods, so from top to bottom here, that was only 10 months. That's like kind of the recession, right? 10 months. And that is from January 11 at the bottom, October of 2011. So let's go from this top, this bottom, 32 months of deterioration. Okay. Then we go to this top, this bottom. We're at about 26 months, give or take. Okay. From this decline right here. Now let's measure from here. From this top over to here. Right now we're at 53 months. So we go 10, 32, 26, 53. That is extended. That is the longest one here in this deterioration. It's also the lowest. Now, when we go back to PMI, let's connect a few dots. So we'll go back to this screen right here. And Raul Paul is talking about this. I don't want to take up the whole screen because I am going to maybe try to put this on YouTube, and I don't want to just take his content here. But what we have here is this ISM PMIs for manufacturing. This is manufacturing PMI against implied Bitcoin pricing. Okay. But just look at these cycles. Something's different over here on the right-hand side. What is different? It didn't have a bottom and it didn't curve and go back up. It was flat. And it's in contraction. Remember, I said it's the longest period in the history of this measurement where they've been in contraction this long. So 33 out of 35 months, the PMIs have been negative or under 50, so in contraction. But that's different. Now, if we go back and again, see that weird tail on this chart. If we go back to the copper and gold ratio one more time. There we go. There's this weird longer tail over here, weird longer deterioration. So anyway, I'm just seeing this all over the place. I'm not just seeing this in the Bitcoin chart. So if we go to Bitcoin, neighbors mowing the lawn right now. In the Bitcoin chart, where's my arrow? We have this weird flat part. And yeah, we talked about over here, we had a kind of a flat part before exponential, and we might see something like that this time as well. But this is much longer, and it happens to be during this PMI, the flat line in PMI, yet we're still going up. So anyway, I'm seeing this weird pattern going in the last 2 years. This weird pattern is showing up all over the place. All over the place. Okay, but let's go back to Raul Paul and listen to him talk about this connection, feel some stuff. All right.
Why is Bitcoin sort of not...
Oh, that's really quiet.
Wildly off to the races yet?
Can you guys hear that? Larry Jr. says you don't hear the lawn mowing, but I hear it, and I can't think. It's right outside my window. Part of his Asia tour. Okay, thank you, Uncle Swan. Yep. But he was it Okinawa? Because I thought those were American troops. Trump over there with the Japanese prime minister. It must have been Okinawa because they looked American. There's also a base in Tokyo, I think, right? There is an American base in Tokyo. So I wonder where he was. But anyways, here we go. Let's listen to this.
Why is Bitcoin sort of not wildly off to the races yet? And it's this chart.
Is he vaping?
Bitcoin is basically, this is a detrended Bitcoin. And it's basically the ISM, which is the business cycle. Remember, we've always said it's the business cycle stupid. It is always the business cycle stupid. And all of these people who claim it's the 4-year cycle based around this and that, they don't understand the fundamental of what the business cycle is, why there's a 4-year cycle and everything. And we've explained it. We'll go through it in great detail tomorrow in our Everything Code presentation. But basically, it's following the ISM. And rates have been following the same pattern. You see, rates should have come lower. They need to come lower because we need to roll the debt. We've talked about this. That's part of the Everything Code, fundamental part. And ISM, because rates are so high, has meant that Main Street has been screwed while Wall Street's made money from debasement. Earnings versus scarce assets.
Let's check that. Let me rewind here.
ISM. And rates have been following the same pattern. You see, rates should have come lower. They need to come lower because we need to roll the debt. We've talked about this. That's part of the Everything Code, fundamental part. And ISM, because rates are so high, has meant that Main Street has been screwed while Wall Street's made money from debasement. We've talked about this. That's part of the Everything Code, fundamental part. And ISM, because rates are so high, has meant that Main Street has been screwed while Wall Street's made money from debasement.
Okay, I keep missing this. I don't know if he's making sense.
And the Main Street has been screwed while Wall Street, we've talked about this, that's part of the everything code, fundamental part. And ISM, because rates are so high, has meant that Main Street has been screwed while Wall Street's made money from debasement.
No. One more time.
Should have come lower. They need to come lower because we need to roll the debt. We've talked about this. That's part of the everything code, fundamental part. And ISM, because rates are so high, has meant that Main Street has been screwed.
Okay, rates are so high, which means Main Street is screwed. This is fundamentally wrong. Rates don't go up. They're not controlled by the Federal Reserve. It's not like the Federal Reserve is screwing people. Okay, when money is loose, yields will tend to rise or be high. So the fact that yields were high, in relative terms to the last, say, 12 years before that, means that Main Street was doing actually better. And it's not that Main Street was getting screwed while asset owners were profiting off some sort of higher yields. I mean, yes, yields are somebody's income. So people that own savings, like savings bonds or treasuries in the money market funds or whatever, they do benefit from higher yields, but their yields are higher because there's expansion, there's growth, and inflation. So it's just a total wrong framing of this. It's like it's like esoteric knowledge or Gnostic knowledge. You're framing this as in that the different puzzle pieces. And maybe I'm doing the same thing, goddammit. But no, I don't think I am. I think I'm explaining exactly why it's not the way that they're saying it is. Because, okay, so what I'm saying is that there's no central planner. There are people making central plans, but that doesn't mean that there's a central planner. Okay, it's everybody against everybody. And what Raul and many other people, I think Brett Johnson would agree with me. I think Jeff Schneider would fundamentally agree with me as well. But people like Raul Paul and maybe Lou Groman, which I don't put them in the same bucket, actually. I put Raul Paul in a bad faith actor and I put Lou Groman in good faith. But they are like, we're going to figure out what the central planners are doing. They are going to try to figure out the secret knowledge and the plans behind the evil people. And they're going to help you benefit, which that's not how it works. Okay. It works by everybody against everybody. There's certain things that cause different fluctuations in the economy, whether that be weather, like, praying for the people there in Jamaica, had the strongest hurricane ever in the Atlantic that made landfall hit today, is hitting right now in Jamaica. And so you have that type of weather. You have just relative moves, like maybe, Russia invades Ukraine, and that sets off a bunch of fluctuations and ripples in the economy. All right. You have a bubble busting. That will set off a lot of ripples in the economy. You have a situation today with Japan and the United States making cozy with each other. Did you see him walking down the stairs? She was actually holding like his arm, like they were a couple or something. They're getting cozy together. And that is going to have ripple effects because that's going to affect the psyche. It's going to affect the uncertainty of that relationship. It's going to make it, a better relationship. And it's going to cause ripples. Now, it's not because it's centrally planned. It's because that's our natural reaction to those things. And maybe that was the intent behind some of those, but those things aren't like centrally mechanically done. Okay, what I'm saying is there's no mechanical process that these central planners are back behind the curtain moving the levers up and down and up and down. They're not doing that. Okay, this is a market process. But Raul would say is that these rates were kept artificially high to achieve a certain outcome. They have achieved that certain outcome, and now everyone's hurting. That's not how it works. Okay, all right, let's continue.
Well, Wall Street's made money from debasement. Earnings versus scarce assets. This is the issue that they need to solve, and they need to get rates lower. They get rates lower. Why? Why do we have an elongated business cycle that looks like virtually no other time? It's because, and I only just found this out redoing the work on the Everything Code recently, is that in 2021-22, they actually extended the maturity of the debt from 4 years to 5 years. So that extension of the maturity of debt has pushed out the business cycle a year. The 4-year cycle this time around is a 5-year cycle. We don't know what the next one will be until we see where they all end up getting refinanced. Whether it comes back to 4 because they managed to get some stuff at the long end, or whether they shorten it because everything's in the short end. We don't know yet. But this one is a 5-year cycle. And this is what it looks like. The 5.4-year sine curve, 5.4 years is the exact average weighted maturity of the debt. And it tells us the ISM should peak by 2026. We think liquidity probably peaks before that, as the rate of change of ISM changes and the rate of change of liquidity changes. Our best guess remains well into 2026, probably Q2. Why is...
Okay, I have to think on that last part. I think there is something to the average maturity of the debt and extending the cycle. But let's take this back one more time to the chart. And we're going to go back to copper, to gold. Now, he's saying that it was extended in 2022. So that would be like in this area. Let me make sure that's going on the right one. No, let me get to the right chart. So he's saying it was extended in 2022. So that would be kind of at the top here. And that kind of does make a little bit of sense because we have kind of a trend here where these tops are in line, right? And then this one was a little bit higher, and that is COVID. So there could be something going on here. I'd have to think about that some more, but now it's back down again. But this overall thing of saying it's changing of the maturities does not explain the 20 years prior to that. All right. What I want to know is this 20 years prior to this. Why is it downward sloping? If we come to commodities in general and we pick, say here, let's make sure it's on regular and get rid of some of these things here. And we put a channel on this as well. This one is ever so slightly downward sloping as well. So we have commodities in general, copper to gold, now PMIs. Okay, so all of these things are in a general trend, and nothing like this. The last 2 years, yes, it's kind of weird. We see it on this chart too. It's a little bit weird here in commodities. What's going on? You could say it's a little bit similar back here to 12, 13, but it's downward sloping in this section as well. Right? So it's just really weird. And I don't think all of this can be explained by saying, oh, it's because the business cycle has just gotten extended by 1 year. Duh. Why didn't anybody think about looking at the business cycle, the PMIs, in all of history to show liquidity? And they didn't realize it was all about liquidity, stupid. No, I think that is overly simplified, obviously. And something weird is fundamentally going on here. It's a little bit different than it has been before, but it's in this huge overall trend. Just typed it. What did I say? It's in this overall general 20-year trend. We can also see this in the U.S. 10-year. If we just go to the U.S. 10-year and we zoom out far enough, it's going down in a straight line, basically, in another channel. Yes, we had a little break up here, but it's going to return back down to this general trend. And it can't go like below zero very much, but it can go below zero, but not by much. But it can come back towards zero. And that will happen again. And this is some weird behavior here as well for the 10-year, probably due to, obviously, supply chains, fiscal stimulus, stuff like that. So overall, I don't agree with Raul that it's that simple. That's probably a part of it. That's probably another symptom, but it's not the overall overriding cause for that. So, all right, let me see if there's any comments. If not, I'm going to bounce out of here, guys. I have soccer practice tonight with my boy, and I'm not seeing any comments. So, all right, thanks for joining me, guys. Hope you have a great evening, and I will see you tomorrow.